Hello, welcome back to Core Finance. I'm Matt Brown. I'm joined by Gaurav Sharma, who is business editor at IB Times and, well, an all-round oil guru. So it's probably a good opportunity just to have a look at what oil's done this year. Maybe afterwards we can have a quick chat of where it's going to go in 2018. So thank you for coming onto the show, Gaurav.
Pleasure. I think 2017 has been the sort of year where we had lots of sound bites, lots of kerfuffle around the scenes, an OPEC cut. And would you believe it? If you look at historic OPEC cuts, they have a dramatic impact. But there was so much oil in the market that OPEC cut once in May and then extended that cut on 30th of November, and still the oil market is what it is. So if you could have the first chart. And if what that tells us is that towards the start of the year, we were about sort of mid-50s using Brent as a benchmark. We had various points, and I'll go through them in a second. And we are round about ending the year at about $65, or where I suspect we would be by Christmas. So that's a gain of roughly just under $10. And I think in the year, what we have, had it not been the supply-demand dynamic being out of whack, we would have not seen such modest gains. So these were the key points. I think the oil price was towards the start of the year. Brent was sort of above 50, so was the West Texas and the Green Line, which is the OPEC basket. All of them were tagging along nice in the 50s, up and until March, when the Saudi oil minister, Mr. Khalid Al-Falih, told an oil gas conference in Houston that the oil market should not take OPEC support for granted. And now, you could see an immediate response to that, and within sort of 2 weeks of him having said that, there were various ministers coming out, oh no, that's not quite right, we are responsible participants in the oil market, and we want a balanced oil market. So that again creates an upshoot. What that then did was, it raised the expectation so high that OPEC cut was sort of priced in. Suddenly what happens is, all the US, around about April, all the US shale players, they sort of hedge at about $45 to $48, in some cases $50, and hedges as far out as 2019. So immediately, again, the oil price slumped, and this time there is a prolonged slump. It slumps all the way to 45. Then OPEC, there's panic in the OPEC ranks. A historic deal is signed. The Russians come on board with 10 other non-OPEC producers, and we have what was a 1.8 million barrels per day cut, rounded off cut, in production between 10 non-OPEC players and, of course, the 14 who were part of OPEC. But such was the expectation that even that was priced in, and people thought that wasn't big enough. And again, there is a decline before oil prices start to firm up and gradually start creeping up. And then the sound bites come again, that OPEC is going to extend, and that sparks this mini rally, which has taken us taken Brent past 60, and brought sort of the West Texas within touching distance of 60, and the OPEC basket is between the two, which shows that the market at least is behaving normally. The OPEC basket usually averages between Brent and West Texas. So that's the story of the year so far. I think we are now engaged in this good old-fashioned tug of war for 2018 between the shale players on one side and the producers that are cutting on the other side.
And what does that mean for 2018? And you also mentioned the hedging taking place. And when we actually look at 2017, compared to other years, the volatility has been there, but not as huge as we've seen, certainly over the last 10 years. So looking at 2018, what are the key drivers? What's going to push and pull, as you mentioned, the shale versus the OPEC producing countries? Who's going to win that tug of war?
You see, volatility is a good starting point. If anything, what this chart tells us that we've looked at is that the oil price has fluctuated, but as you say, it's fluctuated within a certain range. And I don't see it escaping that range anytime soon. And I think it's again this tug of war between the shale players and OPEC producers that you mentioned. And I think if anybody out there, any sort of viewer out there, or any analyst watching this broadcast thinks that shale is going to be on the wane, well, they're kidding themselves, because I think American production, again, this is my opinion or my publication's opinion, I think American production should be quite a bit over 10 million barrels per day. The Saudis are already above 10 million barrels a day, and so are the Russians. So there will still be a fair amount of oil in the market. Having said so, there is discipline within OPEC and the 10 non-OPEC partners. It's a little bit lacking. It was very good to start with between May and, for the first 3 months after May. It was very good to start with. And then of course, you had a bit of a kerfuffle there that people thought Iraq and the UAE, etc., pumping a lot more. Ecuador, a small producer, broke ranks and said they can't cut anymore. So 2018 will be a story of where OPEC and non-OPEC producers were cutting, what's their discipline like. They've rolled over this cut all the way to the end of 2018. That's a bold move. Consensus was that the Russians weren't exactly in favor of that among the analyst community, but they went along for the ride anyway, at least on paper. So 2018, there's this talk that there are these producers who are in the camp of cutting, at least for your and my consumption on paper, if not in actual barrels. And then, of course, we have these American players who've hedged themselves out to 2019. And each time the oil sort of using Brent as a benchmark, touches and goes above 60, you see an immediate response in terms of the US rig count. Now, the last 3 weeks, we've noticed the prices firmed up in the run-up to OPEC and the weeks after that. And there was an immediate response, 4 or 5 American rigs. Last Friday, we had another couple of additional American rigs. And this will go on. For anybody who's sort of spread betting, my advice, be short-term long, play the news, and be long-term short. Because the oil price is sort of in this range of 40 to 60. And I think the OPEC put is sort of, in my opinion, trying to defend a floor that's at 50. In terms of what the city is thinking, there are a lot of analysts out there who think that a plunge below 40 is too dramatic, unless there's a collapse in demand. That's a different story. And an overshooting above the 60 mark is also highly unlikely. So this sort of 40 to 60 mark is what we're fighting at. After OPEC got back to London, interact with loads of fellow analysts in the community, you look at the big investment banks, the notes they're putting out, look at ratings agencies like Moody's, they're also sort of saying that this is, whatever has happened in OPEC does not materially alter their outlook as well, and I concur, because I think we're sort of stuck in this range in 2018. Volatility-wise, I think it'll be a similar affair. As you mentioned, we didn't see the kind of volatility we saw in 2015 or in 2016 for that matter. There were quite a few, at one point we fell to below $30.
Yes.
I think this was, there've been spikes and dives, but it's been a fairly benign year, I should say. And I suspect, barring some very major geopolitical kerfuffle or a collapse in demand, 2018 is likely to be somewhere within range.
Well, you heard it here first. In the meantime, Gaurav Sharma, as always, a pleasure to have you on the show. For this year, we look forward to getting more updates into 2018. Have a great seasonal period, and we'll see you next year.
Thank you. Look forward to it.